d'être avec nous ce soir pour cette troisième édition des Fintech Drinks. My name is Nina May, and I'm the head of partnerships at Fintech Cadence. I'd like to begin by acknowledging that this event is hosted on unceded Indigenous lands. The Ghanaian Gahaga Nation is recognized as the custodians of the lands and waters on which we gather today. So Tio Tiage, which is known today as Montreal, is historically known as a gathering place for many First Nations. So we do this exercise to reaffirm our commitment and responsibility in improving the relationships between nations and improving our own understanding of the peoples, the local peoples and their cultures. So in just a few minutes, we'll have the opportunity to have a great conversation on decentralized finance and the impact on the financial industry. So I hope you're all very excited for the great panels we have lined up for you. So as is a tradition with Fintech Drinks, for the people online who are sharing a drink after a long day of work, we appreciate it. So people in the chat can share what they're drinking, maybe some cocktail recipes or mocktails are friendly as well. And cheers to everyone in the audience, and thank you again for being here with us. All right, so first I will do a quick intro of Fintech Cadence. I have a couple announcements to do, then we'll jump into the panel conversation, and then the networking will resume until 7 p.m. Later tonight. All right, so Fintech Cadence, we are a nonprofit started in 2017, and we are Canada's Fintech hub. Our mission is to advance the financial system to serve all the Canadians for the better. We are able to do this by focusing on 3 pillars. So the first one is education. So we do a lot of work educating talent across Canada on fintech. We support a lot of early stage fintech startups. And finally, we do a lot of work collaborating with the different stakeholders in the ecosystem. We have 5 programs. So the first one is a certificate, which is a 35-hour certificate program that is geared to teach people about the wonderful world of fintech. We have our Ascension program, which is a 10-week program to support founders who are ready to start raising funds. We have the Formathon, which is a fintech case competition where participants can work at solving real industry challenges. Our IFH Lab, which is a 6-month program geared to support early stage startup that improves the financial lives of Canadians. And finally, the Fintech Hub, our latest program, which is a rolling admission program designed to support entrepreneurs when they need it. So by the way, application for Ascension opened today. So if you know any fintech startups who are looking to raise fund in the next 3 to 12 months, please send them to our website. For people at home as well, if you know anyone in your network or you're a startup looking to raise some fund, then make sure that you go and apply for the program. All right. Finally, we host 3 types of events throughout the year. So our Fintech Drinks, that serves to have discussions on hot topics and also as an opportunity for the fintech community to network. We have our university series where we go in universities across the country to introduce students to fintech on a variety of topics. And finally, our Fintech Career Fair, which serves to connect job seekers and employers in the industry. All right, so I have a couple of announcements to make. First, I want to thank EY, which is our champion sponsors for this event, and thank you so much for hosting us out of this beautiful space. You may have noticed that the EY people have a yellow lanyard, so if you want to go and talk to them after the panel is over, well, you can easily spot them. I also want to thank Station Fintech as well as Tories, who are also great supporters of the Fintech Drinks. Finally, our community partners who help us spread the word across the fintech and tech community, Montreal New Tech and Queertech, who are great supporters as well of everything that we do. All right, so a couple announcements. So EY recently released their new report, The Great Convergence, what financial institutions can do to get ahead. They talk about the latest driving forces in the financial sector, including digital currency, which is very on topic for this evening. So you should make sure to check it out on their website. Station Fintech also is launching the next cohort of their accelerator program in partnership with Highline Beta. So the application closed on July 29th. If you know any fintech startups who is looking to join a really exciting program, make sure to send them their way. Also, Fintech Cadence will be hosting an event in partnership with Tories in downtown Toronto on September 27th. So we will do some matching between startups, investors, and corporates to make sure that we give the startups as many opportunities as possible. And finally, a reminder that Finances Montréal, Canada's FinTech Forum, will be back this year in person at the Queen Elizabeth Hotel. It's taking place November 7th to 9th. And the theme this year will be FinTech B2B. All right, so this evening, the panel on decentralized finance will be hosted by my partner, Karina, who's our head of university relations. So without further ado, Karina, I will let you take it away.
Thank you so much, Nina. Clicker. Very exciting event today. As Nina mentioned, I'm the head of university relations at Fintech Cadence. I feel very honored to animate and moderate this panel because it is a topic that is very trending. A lot of people are excited by the future of what will happen with decentralized finance. Of course, to accompany us today and to really deep dive into this very exciting topic, we have Jeremy Clark and Brian Kelfan. I will ask you to come and join me on stage. So Brian is consultant and senior advisor at EY, specialist in financial market infrastructure, digital assets, and regulations. And Jeremy Clark is professor at Concordia University and also the holder of the Blockchain Technology Chair. Welcome you both. Is your microphone working well?
You tell me.
Just switch my
Sounds
on.
good.
There we go.
Sounds perfect. Thank you so much for being here with us today. As some of you might have noticed, we had a third panelist, Louis. Unfortunately, Louis could not make it. Louis is the founder of Catalaxy as well as a partner at RCGT. We really hope the best for Louis. But as someone told me this morning, just leaves more time for our amazing panelists. I'm sure we'll have a lot to cover just with Jeremy and Brian. So to start off, maybe I'd like you guys to introduce yourself. So I'll start with you, Brian. If you can maybe tell us a bit more about yourself, about your motivations, how you got involved into this sector. So I'll let you the floor.
So first of all, thank you very much for inviting me to be here today. It's a real pleasure. And this is my first in-person event in years. So it's a special pleasure to be here. And I'm not, saying anything against the folks who are watching online today. So how I got here, I have spent my entire career in financial market infrastructure. So my training is in law and economics, and after working as a lawyer for a few years, I was hired by IOSCO, which is the International Organization of Securities Commissions, which is the principal setting body for securities regulations. So I worked there for 5 years and really got into the whole policy aspect of market regulation, market operations. I then joined the Montreal Exchange in 2001 when we were transforming from an open outcry, regional, mutually owned stock exchange to a fully electronic, for-profit derivatives exchange with international regulatory recognition. So I see a lot of parallels in terms of the transformation we saw in those days to the transformation we're seeing now with respect to traditional markets and digital assets. And at TMX, I had various roles. I was a head of market operations and market microstructure. I was a chief regulatory officer. I was a chief commercial officer, and I worked in all parts of the business. So a real passion for how things work in the markets. And then I guess starting around 2017, I got involved with digital assets. And I use the expression digital assets as opposed to DeFi or decentralized finance. I think it's a little more all-encompassing. And there I worked on Project Jasper with the Bank of Canada and Payments Canada, where we did on-chain settlement of securities against what in those days we called digital depository receipts, which we now call central bank digital currency. So I go back to before we actually called it CBDC. And I worked on other projects subsequently in terms of principally on the wholesale side of things, how you can realize efficiencies in markets and market operations using blockchain technology. So I have a real passion for the markets and for everything about the markets, how they work, the people who work in them, the policies, the operations. And I find this is a fascinating opportunity now using digital assets and blockchain technology to take us to the next level.
Well, your passion is contagious, Brian. Thank you so much for that. A very impressive background. Maybe Jeremy, if you can maybe give us a bit of your background now.
Okay, so I'm a professor. I'm at Concordia. I'm on the engineering side, so on the technical side. But I do a lot of research that focuses on financial applications of technology. I don't know, a brief history, maybe. I did my PhD at University of Waterloo. I studied voting systems. So in particular, we applied cryptography so that you could cast your ballot. You could see that it made it into the final tally, but you couldn't prove to someone else how you voted. So it's like a secret ballot plus like completely uncorruptible. And when Bitcoin came out, I was still a grad student, and a lot of the sort of technical primitives are the same. And I was working with some of the same people that worked on digital cash in the 90s. And so it was just sort of a natural subject that I was interested in. So I started doing research on it. I didn't know that you could make an academic career in it. I was one of the first to publish any papers on Bitcoin. I think it was the third paper ever in the world on Bitcoin. And and then people started, calling me because they were getting into the space as well. And so I was able to be kind of a clearinghouse for a lot of the research ideas and get in sort of on the ground floor of a bunch of interesting projects. Today, mostly we work on developing real applications. We primarily develop on Ethereum. It's not necessarily because I think Ethereum is superior to anything else. They just have the best tooling. It's easy for students. There's lots of good documentation and things like that. Most of the research community works on Ethereum, if not maybe Bitcoin, but most of it's transitioned to Ethereum. And so we like to study like kind of fundamental problems. We like to study what you can't do with blockchain, like understanding the limitations. So that's something that's a little bit different. And I'd also just say, like in general, I'm kind of neutral on blockchain. As an academic, I try to sit back, and it's not my job to sell you on it or to make you think it's good. It's our job to study it. People are interested in it. Obviously, I wouldn't devote so much time to it myself if I thought it was a complete dead end. But anyway, so I'm somewhere between an advocate and neutral on it. But yeah.
Sharing your colors already. Like it.
Yes.
Thank you so much, Jeremy. So the way we're going to work, I have a few questions for you already prepared. Let's start by quick, rapid questions. But just a reminder, people at home are also listening to us. At the end of the session, we'll have questions. So if you have any questions already in mind, you can start preparing them. And people at home, you can share them on the chat, and they'll be transferred to me by the magic of technology. So you can ask questions to our panelists. So starting by rapid fire questions. In one word, how would you describe the DeFi space? Start with you, Brian.
I was thinking about this one, and I think that if I had to choose only one word, I would say toddler.
Toddler?
Yeah.
Okay.
Because I have a couple of kids, and when they were toddlers, they were running around, trying everything, banging into things, falling down, learning by doing, learning through experimenting. And I think that if you look at the decentralized finance space in particular, and particularly now, you see that happening. So there's a lot, like a toddler, there's a tremendous amount of potential, but further development is absolutely required.
Well noted.
So we both had the parenting in common, because I was thinking infantile. So, but you actually sold me on toddler. I think a toddler is a better description. It's a little more advanced. To some extent, we'll get into this. I think it's a little self-serving. Like a lot of the applications are for the speculators that are in the space, and so trying to sort out, real applications. That's why it's like still early stages. But right now, I think there's a lot of correction going on in the market, and so it will be interesting to see what survives the next year or so.
Self-serving and needing correction, that also
it sounds like a toddler, right?
Yeah. Well, hopefully you have some insight on that as well. Now, same question. If you could only give one word to describe the TradFi space, what would it be? Again, starting with you, Brian.
I would, that I found a lot tougher coming from that space. And I think in terms of the context of our discussion today, I think interconnected is the term I would use. Because as we think about transformation and experimentation, in order for a lot of these financial market infrastructures and these important participants to move forward with new ways of doing things, agnostic of technology, people have to go together. One firm deciding that it wants to clear everything on a blockchain-based clearinghouse doesn't work. Everybody has to do that, or at least a critical mass has to do that. So that's why I chose interconnected.
Perfect. Well heard.
So mine's not one word, it's more like 4 words, but there's some hyphens, so maybe it's 2 words. But I would say high barrier to entry. So that to me is especially if you're going to compose it with DeFi, that's sort of the fundamental difference. I think it's there's a lot of reasons why there's a lower barrier to entry for decentralized finance. Some of them have to do with things that are kind of in a gray zone, like avoiding regulation, for example. But other things have to do with efficiency and the ease with which you can just push something and people can start using it right away.
Wow, I love how that's setting the table for the rest. Last question before we jump into the maybe deep dive questions. What excites you most in the DeFi space at the moment? I'll start with you, Jeremy, this time.
Sure. So for me, I'm actually most interested in maybe a layer below, like some of the tooling and infrastructure. I think the infrastructure projects are really interesting. We know that a lot of DeFi happens on Ethereum. It's slow, and that's holding back DeFi. And so a lot of the projects that look at trying to improve the efficiency, I really like those projects. The actual DeFi services, I think they could be a lot better if we could solve the efficiency problem. So I think they're still sort of young and there's some flaws with how they're deployed.
Perfect.
Yeah, I think that the challenge among many, but I think perhaps the main challenge is, from my perspective, if you look at how you want to achieve market integrity, fair and equal access, investor protection, all of those things that we have traditionally looked for in our marketplaces, and this is a place we've evolved to after hundreds of years of trading in public markets. I think that is a challenge. The ability, the low barrier to entry, the innovation is incredibly exciting. I think how we fit that into the construct of an infrastructure and how we can get more people involved with a measure of safety and security. For me, that's what's really exciting.
Thank you both. That concludes kind of the sort of open teaser for the questions. I think it sets the table very well, because the next question I have, and something that actually, Jeremy, you just mentioned, when we're talking about decentralized finance, we can't escape the fact that we're talking about blockchain technologies. One comment we often hear about blockchain technologies is how amazing they are and how efficient and safe they are. You just mentioned the opposite, so maybe I'll let you start. How true are these statements?
Okay, you can separate them. Maybe safety is something more you mentioned a few times, but like safety for me is like, well, it's the opposite would be risk. And it's hard to solve risk. It's easy to push it around. So you can kind of say, okay, we're going to make it so you don't have to trust this aspect, but you push the risk on some other aspect. So I think blockchain does that a lot. It kind of pushes risk around. But I'll spend more time on efficiency. So efficiency is a complicated answer. I don't think there's an easy answer to it. So let me give you an example. Let's say we think of equities or like buying stocks, right? So is it more efficient than paper stock certificates, OpenCry, human traders on the trade floor? Obviously, right? Is it as efficient as a fully electronic exchange like NASDAQ? It is not, right? That can process on the microsecond level. But blockchain would be somewhere in between. It might be like 12 or 13 seconds for a transaction, okay? So it's somewhere in the middle. Now, that's one way of thinking of the problem. But another way you might say, well, if you go to NASDAQ, yeah, you can execute a trade in a microsecond, but it doesn't actually settle and clear right away. That's just the execution, right? So then you might think, well, what about the full lifespan? Like settle, clearment, like it was in my pocket, you have money in your pocket, now it's in your pocket and the money's in my pocket, right? And so Ethereum, for example, or a blockchain could do that within the same 13 seconds, right? Whereas an exchange, you're thinking like T+2, T+3 days before that happens. Now, a lot of this is sidestepping regulation and things aren't registered and things like that. So, there are tricks that blockchain plays in order to make that happen. So anyway, so it's a complicated answer. You can't really say it is more efficient or it's less efficient. It removes intermediaries in the best cases, and so that can add efficiency. But then at a technical level, it's also slow, so that removes efficiency. So you hope that on balance, it comes out more efficient, but I don't think it's like open, close. It's more efficient than anything.
Yeah. Those are really good points. And I'm by no means a technical expert. And I understand the comment with respect to the technical efficiency. In terms of what market efficiency means and price formation and liquidity, there are some potential benefits to a decentralized model as opposed to the centralized model. Clearing and settlement is absolutely one of them. And I've worked on a couple of projects where we actually did experiment with clearing and settling securities against a payment unit, whether it is a central bank digital currency or a utility token on chain. And you can achieve that atomic settlement. And if the participants are ready for it, you could go to a T+0. And then you start getting into efficiency discussions about collateral efficiency. Is it most efficient for the participants to settle everything gross right away? Is it more efficient for them to net things? So there are a lot of design choices that are available to you when you're designing these systems with respect to efficiency. In terms of things like price formation, the more information you have in the market, the more people have access. Potentially the ability to fractionalize real world assets into smaller pieces, you can achieve greater liquidity, can contribute to a more efficient market. So I think from a market operations perspective, there is a lot of opportunity for efficiency. And I think, as well, in terms of the underlying technology, there are, as we move away from proof of work and towards other validation mechanisms, maybe we can achieve some of those efficiencies on chain.
Yep. Can I just pick up on one thing? So the efficiency is not always a good thing either. So sometimes you don't want efficiency. Like I'm old enough to remember where you could go to a grocery store and write a check, right, and pay for your groceries. Does your money have to be in the bank account when you hand that check over? It doesn't, right? The grocery store is going to take it the next day or at the end of day or something like that. So you would have a few hours in theory to get the money. You want the money there when they cash the check, but it doesn't necessarily have to be there. And that might sound like a silly example, but banks like that, right? When you're doing large value payments between banks, they don't always want to have, every dollar sitting there in order for them to move. They want to net out at the end of the day. And so, so you can do like sort of credit-based systems and things like that in a system where there aren't efficiencies, where not everything is instant.
Well, that's exactly how the securities market works. In fact, there's an aphorism we say where people are selling stocks they do not own to buyers who don't have the money to purchase them, and that's how the markets work. That's how clearing and settlement works, and that whole practice of managing your settlements is all about that. I have to buy from Jeremy, but before I have the money to buy from him, I have to sell to you. And then it's a question of who goes first. Mm-hmm. If you want to go to a real-time gross settlement system of atomic settlement, you do away with those problems. But as you said, to some participants, those aren't problems; those are advantages.
Exciting. We talked a lot about efficiency now, as I can see, and we didn't mention much about the safe part, but as you were saying, the contrary of safe is riskier. What would be some of the risks of having a financial system on a blockchain, private or public?
Sure. Go ahead.
Okay, so I think, and when I say safety, I'm talking about from the perspective of it's from the perspective of the individual investor. And it's also from the perspective of systemic stability. And I think that the biggest challenge is we operate on a model today where institutions are accountable and they have to meet certain criteria to be involved. There are protections for investors. There are fail-safes. There is a mutualization of risk in the system. And as we move to a more decentralized system, we have to figure out how we can provide some of those benefits in the new paradigm. One of the ability to access the market in an unmitigated fashion by an individual investor is a double-edged sword. Yes, it lower barrier to entry, but who is the counterparty that individual is dealing with? Does the counterparty have the kind of knowledge or sophistication to understand what they're entering into? Can they be easily misled? And we address all of these things in the current system, and there's a series of gatekeepers involved to do that. Once you remove all the gatekeepers, presuming that that type of protection is still one of your objectives, how do you achieve it in the DeFi space?
Yeah, and then more at maybe a technical level. So blockchain. Well, let's just use a concrete example. So let's say I have money sitting in a bank account. So that's world A. World B, I have Bitcoin or Ether or something sitting in my pocket. So in the first case, if the bank fails, my money's gone. Maybe it's protected by insurance. So I get it from the government. Maybe it's more than the insurance covers, so I get some of it back or something like that. But there's that risk. So Bitcoin people will say, well, you don't have that risk if you can be your own bank, right? So that's great. It sounds good. That sounds like an improvement. We reduce the trust that we need. But what does it mean to be your own bank? Well, it means I have some crypto keys. They're sitting on my computer. And if I ever lose those, right, my money's gone. Like I can't reset my password. I can't go to someone and try and get it back. I can't prove who I was and that I had access to it. You know, it's completely unforgiving, right? If I get malware on my computer and malware does this, first thing it does, well, not maybe the first thing, but one of the top 3 things it will do is it will look for all your keys, right? And your accounts will get drained. And so, yeah, you lose access to money and things like that. So safety is one of those things that you can push it around a bit, but you don't really fundamentally solve that, right? So there's still risks in a blockchain system. They just look different than risks in a financial system.
There's no perfect world, isn't there?
Yeah, I mean, I would add a further level of refinement there is that when we talk about risk, we talk about managing it. You can manage it up, you can manage it down, right? You can move it around. You can't eliminate it. But those, again, are policy decisions, which will then entail design choices.
Exactly. Perfect. Great addition. Let's talk now about the future, maybe. There's a lot of contradicting views when it comes to decentralized finance in general. Some very enthusiastic people believe that it will completely replace our traditional financial system. Other people believe that cryptocurrencies are just assets and they will always stay assets. What are your view on the future of cryptocurrencies in general? Do you think it will collide, coexist, or perhaps converge with the present financial system? I'll start with you, Brian.
So I like the word convergence, and I think that and there's 2 parts to your question. When we talk about convergence, I see us in a period of convergence where traditional financial institutions are looking at decentralized applications. They're looking at blockchain technology. They're looking at the instruments that can be created and used and traded, and at the same time, in the DeFi space, creators, innovators, disruptors, they still need capital, they still need access to markets, they still need access to developers. So they're appealing to traditional finance, traditional finance is experimenting with DeFi. So I think we're on 2 paths, which ultimately will converge in a new system. And I'm not saying that one will dominate the other, but we've seen this before, right? We've seen dematerialization of securities. We've seen electronic trading. We've seen, I still have friends who are at the DTCC where they had to, after the hurricane, separate stock and bond certificates one from the other because they were in a basement vault that got flooded, right? So we have seen, that's no longer a problem. So we have seen dramatic changes there. In terms of the the coexistence of different, let's call them asset types, cryptocurrencies, stable coins, central bank digital currency, commercial bank money, cash. I think that they all have use cases which are adapted to their use, and they have value because of those use cases. So I see a world where in the future where I'm working, that we will have stable coins that are coexisting with commercial bank money, maybe stable coins based on commercial bank money, based on bank deposits, which we're starting to see develop. Cryptocurrency has a place, potentially central bank digital currency as well. And I think that all of these instruments have use cases, and they will be valuable and used so far as they satisfy those cases.
Interesting. So converging, that's the word I keep in mind. Do you have something to add, Jeremy?
So my view would be quite similar. I'd say I would maybe use the term hybrid. So I think we'll have a kind of hybrid future where there will be some decentralized options, there'll be centralized options, there'll be centralization within DeFi even. Maybe vice versa. One thing I see a trend that you probably know more about than I do is like fragmentation of markets. So like if I want, well, let's take the equity example. So I want exposure to Google, right? I can buy stocks, I can buy futures, I can buy a derivative product. There's lots of different ways of getting that exposure. Let's say I decide I want to buy stock. Now there's a whole bunch of different exchanges, or I can go to a crossing network or whatever, right? So there's all these different venues, and they all exist. They didn't converge. Why is that? I assume because they have different fee structures, or like there's slightly different rules for all of them, and so different traders at different times want a certain set of rules to operate under. And so I think decentralization brings a completely different set of rules, and the fees look different, the timing looks different, and there's enough differences there that it's an interesting alternative. And so it's somewhere that you might go if it matches your conditions, and in other cases you'll go to the centralized service.
Yeah, the point you make about fragmentation is a good one, because, and again, if you look at, as you just referred to, the traditional markets, the reason that you can have multiple venues trading the same thing with nuanced and different rules, but all of those listed derivatives clear and settle in the same place, no matter where they're traded. All of those securities clear and settle at the same place, no matter which platform they're traded on. So that fungibility, being able to enter into a position in Chicago and exit in Philadelphia, really contributes. The fragmentation doesn't happen at the level of the clearing and settlement of that instrument. So the liquidity pools are essentially integrated, and that would be an interesting. We should have that discussion offline in terms of how that would work in terms of decentralized operating systems and the instruments on them, and how you can, because today we have a completely fragmented market between the even the centralized derivatives, the centralized crypto exchanges.
And that's how we change the world. We started a Fintech Drinks, and then we finish off on a conversation. So you've mentioned it, having a decentralized system would have some regulatory challenges. What are some of these challenges that we can expect if they're going to become more mainstream?
Okay, so our friends from the AMF are sitting in the front row. So obviously, they're the experts, but if you're issuing something to consumers that looks like a security, you have to undergo regulation. Sell it to accredited investors and things like that. So there's regulations from security law. If it's some sort of currency, especially if it's an exchange, you have to think about KYC, know your customer, anti-money laundering, the stuff that would fall under the umbrella of Fintech in Canada. I imagine the Bank of Canada might have something to say if Bitcoin use or cryptocurrency use in general became large enough that it had some sort of economic impact. So my feeling from talking to people at the bank is that it's not at that stage yet. So they're not too concerned, but they are watching it and trying to measure different, like the user activity and things like that. Taxation is going to be another thing. So if you make a killing, buying NFTs, CRA is going to have something to say about how you register that. So those are the ones off the top of my head. Did I miss any?
No, I think that's a really good inventory. The Canada is actually ahead of many jurisdictions in terms of the way that it's approached the regulation of centralized crypto exchanges, because it said that, you know, we're going to define, because the customers don't actually have the tokens in their own custody. They're custodied by the exchange. Therefore, they have a contractual right to that coin. Therefore, it's either a securities or a derivatives contract. Therefore, we have jurisdiction. And you have to register as either a dealer or a marketplace, depending on your business model. So that is certainly one way of doing it. And that works for centralized exchanges where you have, as we used to say in the markets, a neck to choke. If everything is decentralized and you do not have that neck to choke, how do you regulate, how do you supervise that? And I think that's a challenge that requires some thinking. Ultimately, most of the protocols start relatively centralized. Some of them are still very centralized, whether in terms of who controls the governance tokens, or the developers who support it, or the ability to actually interact with the smart contracts and change them and reverse things. So there are, again, I mean, that's another way to get at that element of supervision and regulation. So there are challenges. There are paths to address those challenges. And I think it just requires more thought and experimentation. And it's in everybody's interest. You know, I read that the Basel Committee of Banking Supervision published a consultation paper on the prudential treatment of crypto assets. And I recommend that you read it, not just because it will, you know, help you fall asleep, but they talk about a lot of really interesting concepts. They published an initial set of treatment requirements, which basically said if it's crypto, you have to have 100% of your capital allocated to it. And a lot of the big financial players came in and said, that's a mistake. Because if you exclude the large financial organizations from those markets by making it uneconomical for them to participate, then you will not have the type of market integrity and the institutions that have responsibilities with respect to market integrity and investor protection. So I think that's another way to get at it, is through the participants on the market. Because ultimately, if markets are shown not to have integrity, then no one will participate in them. And then what's the point of developing the protocols if no one will come to play because they think it's a rigged game?
I really like next to choke. That's a good term. We always use the regulatory hook as our like boring academic version of saying the same thing. But a lot of DeFi, actually, if you look at it, like real Ethereum DeFi, as you mentioned, there are regulatory hooks. So like contracts can be paused. Someone has authorization to do that. Usually they can be upgraded, even though that seems to be a contradictory statement because blockchains are immutable. But anyways, there's a lot of complexity around that. But there's someone that can do it. Yeah. Lots of companies or foundations, you have the developers. And so those regulatory hooks exist, even if it's completely decentralized.
Super interesting. We're getting closer and closer to a system that seems to work, as I understand. So of course we talked about cryptocurrencies, we talked about digital assets, but more and more people are talking about digital tokens. They're becoming very popular. Can you give me some examples, maybe, of applications of tokenization of digital assets? I'll start with you, maybe, Brian.
Sure. So I was part of a project with a group of central securities depositories. And for those of you who might not be aware, those are the institutions which house on their ledgers all of the securities that are issued in a country. And we were looking at problems of, I am a bank with operations in Canada and in South Africa. I need high quality liquid assets. I need these government securities because I need them to back up transactions that I'm doing. And I have a bunch of them in Canada, and I have a bunch of them in South Africa, and I have more in the UK. The banking hours are all different. It takes 5 days and costs thousands of dollars to move things across borders through the banking system and the introducing banks. How can you make this more efficient? Well, you can lock up that bond. The smart contract, when it sees that that bond is locked up, it spits out a token. And then you can move that token around the world 24 hours a day, 7 days a week. So you can address liquidity shortages in one country with a liquidity surplus somewhere else without any operational friction whatsoever. So that's a great, as an infrastructure geek, that's a great application. You have other types of applications like, as I referred to, fragmenting real world assets that are large and bulky into smaller pieces and allowing more people to trade them so that you can achieve greater liquidity, better and more efficient price formation. Cross-border is another, right now we, with the current banking system, it's very important, it's very expensive to move money across borders. If you have a token that represents money or that is money, then you can achieve a lot of efficiency. So that's just 3 examples, but I think there are a lot of them.
So in terms of what we see on Ethereum today, we generally kind of break them into 3 classes, I would say. So some services have what's called an access token. So it's basically you need that token to use the service. Now, could they just run, like usually it's because it has some monetary value, could they just run it with ETH instead? Probably, right? It's like, I don't know, Chuck E. Cheese money or something, or Canadian Tire money or something. Like you could just...
Wait, that's not real money?
Yeah. It has uses though, it gives you access to it. But it's used only in that venue. So some people are skeptical of it. They think that it's just a money grab. And then the companies will sometimes say, well, it funds our projects and things like that. And the big problem there is that sometimes you buy the Canadian Tire money before Canadian Tire is even built. So it's like, I have this idea for this like store, and imagine you could have automotive and you could have like hardware and you could buy a bike there, and it would be, we'd have them in all the major cities, here, I'm going to sell you some Canadian Tire money. You'll be able to, like, once we build the stores, and I'll take all the money that you give me and then I'll build the stores or whatever. So anyway, so there is some criticism of that. A more popular option now is called governance tokens. So this is where you have a protocol, you have some parameters to the protocol, and you want, instead of the founders of the company to be the gods that like make the decisions, you're going to have a big vote amongst all the people that have these tokens. So you distribute the tokens somehow, and and then you can always buy them. There's a secondary market for the tokens, and then you can vote on how the parameter changes. And then equity tokens would be like the idea that you take some real world thing or some off blockchain thing, whether it's digital or real world, and you tokenize it. And equity tokens work, the main fundamental problem that you have to overcome is, I call it the stapling problem, which is if you have one object that's off blockchain and you have a token that's supposed to represent it, you want to make sure it's one-to-one, right? And so there's no way really to do that other than to trust the person who stapled the two together, that says, because they could issue the same token even on multiple blockchains. If you want to get really sneaky about it, you could have a bank account with $1 million and say, I'm issuing 1 million stable coins on Ethereum. And then you could turn around and do the same thing on a different blockchain, right? And then you just point to the same bank account and everyone's like, oh yeah. So, or maybe you take that $1 million that's sitting in the bank and you do something behind the scenes with it. Like you go to the bank and say, oh, I want to collateralize a loan and I have $1 million sitting in this account. And the people who own the stable coin don't know what else you're doing with that money because they can't see it. They can just see that you have an audited statement that says the money's in the bank or whatever, right? So you do want to actually like you have to lock the token and then issue things one-to-one against it. And so, yeah, that becomes problematic. And I guess it's also problematic in the traditional finance as well. Like I guess, I don't know this space at all, but I hear blockchain people complain about like naked short selling. And it seems to be an issue where more securities are issued than there actually are securities in circulation? Or
no, actually, naked short selling is you borrow securities and you sell them.
But you borrow them and they don't actually exist. Like they're manufactured, and then if you can close your position because it takes 3 days to settle, it doesn't matter that they don't exist.
No, well, you promise to deliver, right? Okay. And you don't have to deliver until the time you have to deliver. So you have to source those for delivery, but that you're not creating securities the way that the banking system creates money, right? That there's only one share, and it can be borrowed and lent and borrowed and rehypothecated but there's only one. So you're right that challenge of and I like the stapling analogy is a real one, but these are all, that's not unlike issues that we have to deal with in the markets today. Because, by the way, none of those things exist in any form other than zeros and ones on a ledger today, mostly on mainframes, believe it or not. So that's not so much a policy challenge, I think, or a design challenge, but absolutely something you have to keep in mind.
I love how, Brian, you always have that view of market, and then Jeremy always has that very academic view. It's perfect. You guys really complement each other. Time is flying. I have maybe a quick question. So we're seeing, you've mentioned before, Brian, we were talking about central banks issuing their own digital currencies, what we call CBDCs. Why do central banks want to create their own digital currencies, and how are they different to stablecoins? How are they competing with stablecoins? Can you maybe start with you, Brian?
Okay. So I think that the first defining characteristic of a central bank digital currency is it is a direct claim on the central bank, like a $100 bill. So if I have money in my bank account and I send it to you using the instant e-Interac, which is only fictionally instant at the moment, I'm sending you commercial bank money. I'm not sending you central bank money. At the end of the cycle, the banks get together and they net everything out, and then they settle between themselves in central bank money. So there's a difference between commercial bank and central bank money. And different central banks in different regions have different priorities with respect to why they're developing CBDC. In many places, it's to solve the challenges of the unbanked and underbanked, people who don't have access to bank accounts, either because of geography or because of cost. And there's the potential for a central bank digital currency to provide that access. There's a great example. Most people don't talk about it in the CBDC discussions, but it's Project Bakong in Cambodia, where 70% of the people have smartphones, 30% have bank accounts. So they actually implemented a system based on, I think, a version of Hyperledger, where you can move currency. You can open up your account through your phone, and then you can move this central bank managed token throughout the system. So that's a reason. A reason you mentioned, Jeremy, that's a very, I guess, predominant in the developed world is the concept of monetary sovereignty. And it wasn't that's that if you lose control of currency, then you lose the ability to manage monetary policy. And it wasn't so much Bitcoin that scared everybody into it. It was DM, it was Facebook. Global stable coins that could potentially, would be run by for-profit corporations with their own agendas, could potentially take those monetary policy levers out of the hands of central banks. So central banks were concerned about that. Declining use of cash. Sweden is developing their CBDC because nobody uses cash anymore. So there are a lot of different reasons. Just to give you a sense of the scope and scale of this, I think at last count, there were more than 90 central banks doing experiments with CBDC, representing more than 95% of global domestic product. So.
Sure. So I'll pick up on the second part of your question, which is, so you have stable coins as well, which you've probably heard of. And so this is a company basically locks up, let's say, Canadian dollars in a bank account, but they might invest it elsewhere. And they issue the equivalent number of tokens. And so that's meant to be a kind of stopgap CBDC until you actually have CBDCs. So the thinking always is that a CBDC would be a rival with a stable coin. But once again, I think it's a little more complicated. So I don't think that they're necessarily rivals. I think they are in certain circumstances. So you have to think about, why are people using a stable coin today? So one case is that they're on Ethereum and they want a US dollar on Ethereum. Okay, is the Fed going to issue a CBDC on Ethereum? Probably not, right? And so that actually, the CBDC doesn't solve that problem if you want US dollars. Now, in this case, a CBDC could actually make it better. It could enhance the stable coin because the company like Tether, they could hold their reserve asset in the CBDC, and then it's conceivable that it would be easier to prove like that they're one-to-one in terms of tokenization than it is when they say, oh, we have it in commercial paper somewhere, and you go to the markets and you talk to the market operators and they say, oh, we've never seen a company that would supposedly have that much capital like come through our markets. So anyway, so it's very like these stable coins can be kind of there's a lot of question marks on where their reserve assets are. So that's an example where they could complement. Other things is you want to get out of an exchange quickly. So I want to get out of my Bitcoin position. I can buy Canadian dollars, I can withdraw it, but then I'm waiting 3 days and I have to pay for like a wire transfer or something like that. Instead, I could withdraw it to a stable coin, then I can move that stable coin to another exchange or something like that. So that's a case where a CBDC would be a rival, right? I wouldn't have to wait 3 days if I could withdraw it as a CBDC, presumably. So anyway, there's a few other use cases, but it's a complicated story about the relationship between the two of them.
I'm learning so much tonight. I don't know about you at home or in the room, but wow. Time is flying. I would have so many more questions to ask. Maybe one last question, jumping a bit on what, Brian, you kind of gave away a part of my question already, so I think it's a good one to finish. At home, I have some questions. So when we're talking about crypto, DeFi, we often hear that the paradox of financial inclusion. Some say it's a viable route for financial stability. Others suggest that it recreates the same inequalities that we can see in traditional financial system. Can DeFi provide solutions for financial inclusion? You've already mentioned one example, but is it a viable route for financial inclusion? Maybe I'll start with you, Jeremy, since
Sure.
Brian already came.
Yeah, so DeFi comes with a set of things that you need. So you need some sort of internet connected device. Otherwise, you're probably not using blockchain. You need to have that internet infrastructure, right? And then electricity would go along with it. And most systems that you would want that would actually compete with the banking services that banks provide to the banked, if you want to bring that to the unbanked, is you would need some sort of identity system. So you would have to know who the people are. And so all of those have enrollment costs, there's technology costs. And so you can't just say, oh, DeFi is going to improve financial inclusion. I don't see that necessarily. I'm not saying it's going to make it worse, or there are ways perhaps to do it, but it's not a silver bullet at all. And you still have to like sweat the details that have nothing to do with the technology. They really have to do with the infrastructure around the technology.
I agree with that. I do think, though, there are costs that can be taken out of the system through a direct access to the ability to move money. And I think in some of the emerging markets, you see that. I mean, Africa is a prime example where people were using cell phone minutes as currency, right? Because they didn't have access to the banking facilities. And if they did have access, minimum balances, transaction fees, all of that stuff really puts it out of the reach of people. In fact, even Canada, I think the last survey that I saw showed that 20 to 25% of the population is underbanked, meaning that they might have a bank account, but they can't access all the banking services because they can't afford to pay for it. So to the extent that that infrastructure that you referred to is there, needs to be adapted and needs to be paid for. But whether it's DeFi or whether it's fintechs, there are opportunities to compete and disrupt with the system to offer less expensive opportunities to give more people more access to the system.
And we are excited by those avenues. Question from the public. If you are in the room right now and you have a question, please raise your hand and you'll be next. But I have a question from the public at home from Talam Alameddin, who says, what are the biggest challenges for the tokenization of bonds and other financial instruments? Is it regulation, technology, or the business case?
I'll start with that one. So the business case is fundamental. So you don't start unless you have a business case, right? Or a use case. For a while, people were looking at the technology as this is this really shiny new toy. What can I do with it? And trying to find applications. We're at the point now where you're looking, okay, I have these problems. Is this the right solution for the problems? So use case is number one. I would say that a lot of the legal structures, not just regulation, but legislation and how things are characterized, that is a challenge. When we did the mobilization of high quality liquid assets on chain, the technology was easy. We used Hyperledger, Fabric. We just deployed it. It worked. Technically, everything worked. It took months and months and months to get legal opinions to the extent that this thing actually represented ownership and what happened in the event of default. So there are once you have the use case, the technology is there. You have to find the right one, but the technology is there. And then it's a matter of how does this work within the legal system as it operates today? How are these things characterized so that all of the functions of a security can operate in this new form the way that it operates in a more traditional form?
So for me, I'd say that if by tokenization you mean like on a blockchain, like say Ethereum, you could do that. And I'll think of from the company of the firm that's issuing, so you might call it commercial paper instead of a bond. But I've often puzzled about that because technically it's very easy. You could easily throw up a contract that would take care of all the technical details. And I've talked to people about it, and maybe it's kind of a controversial take, but I think the reason we don't see it is because it's too easy to get money other ways. So companies don't want to borrow if they can give up equity to an investor, or even if you roll back 4 years, they can just release a token and raise lots of money that way. And so I think that a lot of firms, they just aren't stretched to the point where they want to borrow. And if they were stretched to that point, then they might start exploring tokenization, like issuing bonds like on a blockchain or something, but then they're going to have all sorts of regulatory issues.
Thank you. Does anyone have a question? Oh, I have a question here. You can say very loudly, and I'll repeat it if it's not loud enough.
So, video game companies have been selling like digital assets for years, maybe decades, but nearly decades. And so you kind of have benchmark values where you see how it is easy or complicated to implement like a marketplace with today's technology. So do you have like comparative value, how easy or difficult is it to implement with the blockchain? And to compare it with existing needs.
And you mean the value of the digital asset itself, or you mean like the fees around the market and stuff?
I'm currently starting a video game.
Yeah.
So of course, having the ability to implement a marketplace is something that I'm interested in.
Right.
But not the blockchain necessarily. So me, I'm just interested in how easy is it to implement a marketplace, a digital marketplace.
Right. So the promise of Ethereum, like say you issued your tokens on Ethereum, is that you shouldn't be implementing your own marketplace. What you should do is get your token listed on some other company, and their specialty is a marketplace. They have the website, they have everything that you need. So that most people would say that infrastructure you shouldn't care about it, right? You should go get a turnkey solution, and so that's what video games will do that are decentralized. They issue assets on the blockchain. They don't implement their own custom marketplaces. They'll list them with existing, like Uniswap would be an example of an existing Ethereum marketplace. And as long as the token that you're selling, is technically compliant with some really light standards, you can just plug and play. And you need the users too that will come along and supply the token and set prices and things like that.
But in terms of cost for the company or for users, is it like, are they comparable? Or?
Yeah. So there's essentially no cost. So if you want to issue your token on Uniswap, for example, you don't pay anything, right? That's the beauty of Ethereum, is it's just decentralized, and your users will pay a fee, an Ethereum fee, not to you, not to the exchange. They'll pay it to Ethereum in order to actually turn their ETH into your gaming asset, or vice versa. And then Uniswap might take a fee, or they do necessarily take a fee as well, but not to the company. It's to the people that provide the tokens to be swapped. It's kind of complicated how it all works. But essentially for you as a firm, you can, in one afternoon, have your token deployed and listed. And yeah, basically no costs other than having someone that knows how to do it.
So it doesn't offer to the customers where they don't have control over the transaction fees.
Yeah. So there'll be transaction fees that will be offloaded to the customer and to the people that provide the tokens as well.
Yes, question.
There's a lot of things that really interest me. So I'm going to talk about something that interests me a lot. So I'm an engineer. So I know there's a lot of topics based on finance and like financial services and DeFi. But as an engineer, what really interests me is actual productivity. For example, one of the applications of crypto is the Helium network, we're having their own antennas, warehouses, like antennas, and eventually people want to use those antennas to like provide an alternate network for cellular, for example. Or we're talking about Starlink kind of satellites over there. People can have a share of their satellites and use that to like provide services. Or we can talk about the Avalanche network, where they eventually want to provide cloud services, and everybody can come and contribute from make some money from it. So my question is, can the crypto space or DeFi, can they produce their way to being something big, or is it ultimately dependent on the TradFi people to come and support this and help the industry?
Just before you guys jump into the question, I know at home they have a hard time hearing the people in the audience. So the question is there a way to scale solutions without passing through the TradFi systems when we're talking about blockchain technologies? Did I capture that well? Can we produce our way to a larger economy?
Well, there is a question, a controversial question about the productivity that is generated by the financial services business in terms of the overall productivity in the economy. Are you making things? Some people would say no, you're helping people make things by helping to provide financing and access to markets. So I think to the extent, the way I would answer your question as a financial markets person is that to the extent that we can develop liquid, efficient markets with that function well with market integrity, that will provide more financing opportunities for businesses who are producing real things as opposed to producing financial products. So yes, I think that, and as you get more people involved in deploying their capital and you get more pools of capital, big and small, involved in the markets, then you have the opportunities to finance. This is how the railroads were built, right? In the 19th century, by mobilizing capital. So capital mobilization, to the extent that DeFi can generate more efficient markets and more accessible markets, that can potentially mobilize more capital to finance the projects that you're talking about.
Oh, but that's kind of where, that was my caveat. So I understand what you're saying. So you're saying you need the financing for these markets to grow, but in some applications, the financing required is very minimal.
No, but what I'm saying is that without respect to how the protocols or the development or the infrastructure is financed, that if you're talking about building real engineering structures, you're talking about antennas, you're talking about computing capacity, right? To do that, you need money, right? And where do you get the money? You get the money from investors or from lenders. And to the extent that there are more investors and more lenders and that the barriers to access are lower, there's more availability of capital to finance those projects. So that's my response.
I have two last questions, one here and one online. I'll ask the online one. What are the implications of La Caisse de Dépôt's investment in Celsius crypto market?
So can you repeat it?
Yes, what are the implications of the Caisse de Dépôt's investment in Celsius crypto market?
I didn't catch the name.
Celsius.
Celsius, but
Yeah.
whose investment?
CDPQ.
Okay. I don't know anything about it. Yes, I didn't even hear about it.
I'm not going to comment on that, but I will say that I think that large institutional investors and public pension plans are making forays into the space. And one way and part of it is a learning exercise. How does it work? Why does it work? What does it offer? And one of the best ways to do that is to have some skin in the game. So put a little bit of money in, and then get a board seat and understand how these things actually operate. But that's without any respect. I'm not referring at all to the case or Celsius there, but as a general rule.
It's a good answer, Brian. At least you answered.
I went to law school.
Can you bring the microphone to the last question?
All right, thank you. My question is, how do you see the competitiveness of Ethereum compared with other layer ones in terms of attractiveness to DeFi, as as Ethereum is branching off to a lot of layer 2s. The companies who want to operate DeFi companies, their liquidity gets fragmented a lot. Do you see that as a danger for Ethereum to lose its place as a place of choice for DeFi?
Sure, I guess that's sort of in my wheelhouse. Okay, so what you say is true. So Ethereum has scalability issues, and so a lot of people are looking at either replacing Ethereum as a layer 1 or building something on top of Ethereum that interfaces with Ethereum. So that's what layer 2 means. So by definition, most layer 2s, you still need Ethereum. Ethereum's still the underlying platform. And so Ethereum doesn't go away, it just kind of changes its purpose. So as opposed to actually executing your transaction for it, it's just a place to record the transaction that you want executed. Someone else will execute it off-chain on the layer 2, and then you're going to have some assurance that when they come back and say this is the result, that you believe that actual result. So I don't think that layer 2s necessarily, I think they complement Ethereum as well because they integrate with Ethereum. Things like someone mentioned Avalanche. So that's an example of something that is more of a layer 1 competitor. But right now they're operating as if they're a layer 2. So you bridge onto Avalanche, but they could technically just completely replace Ethereum. You could replace it with it. And yeah, I think Ethereum is vulnerable because they have scalability issues. I think that ETH 2.0 will address some of them. I still think that layer 1s like Avalanche are better than ETH 2.0. But the other thing is that there's a lot of stuff on Ethereum already, right? And so do you want to go to some other blockchain, even if it's marginally better, right? But there's no users there. There's no customers, there's no values, there's no tokens. And so I think that for Ethereum is safe in the short term because they have that kind of legacy status. Now, the layer 1s are smart because they're developing their blockchains to be EVM compatible, which basically means, hey, if you have your Ethereum thing existing, just copy and paste it on our blockchain and it will work exactly the same, right? And so I think there is a medium to long-term threat to Ethereum. I don't know that in 10 years we'll all be using Ethereum for the kinds of things that we do today. We might be on Avalanche or something else.
Thank you so much. I'm pretty sure we can go on and on and on for hours, but I feel that the people in the room start to be thirsty. So I'm going to have to end the conversation now, but thank you so much for being here, Brian. Thank you so much for being here, Jeremy.
Pleasure. Thank you.
As always, thank you everyone for being here. Thank you people at home for listening in. Networking is already online, I think, so you can start networking. For those who are in the room, it will be in a few seconds. And of course, we will say see you soon because our next Fintech Drinks will be in September, I think. So follow our social media and tune in for next time. So thank you, everyone.
Thank you.
Thanks.